So the main thing we're going to talk about in the first part of this class is revenue recognition. Okay, so remember that earnings are the difference between revenues and expenses. So revenue recognition tells us when we can recognize revenues, and then expenses are matched to revenues by the matching principle. So revenues are really important in the sense that it determines how much sales you have, and it also determines how much expenses you have. So two critical issues are, when do we earn revenues, or when can we recognize the revenues? That's going to be the first part of this class. And then later on in this class, we're going to talk about estimating how much of those revenues are not going to be paid to us because they're bad debts, or how much of those revenues we're not going to make because our customers return items. Now we just want to go through some examples of some revenue transactions. So we're going to use Dell as an example. So many of you have bought a Dell computer, so you buy a computer over the website. Let's say in the first transaction, you buy a computer for $1,000, you put in your credit card, so it's basically a cash transaction. So let's think about what happens. Dell's going to get cash of $1,000. It's going to recognize $1,000 worth of revenue. The computer costs $500, so out of its inventory, we're going to send out a $500 computer, and that'll be our cost of goods sold for this transaction. Now let's just do a slightly different transaction where Dell sells the computer, and instead of getting cash, it sells it on account, which means it gets an accounts receivable for it. So as you can imagine, the transaction is going to look very much the same. So we got an accounts receivable instead of cash. So the customer promised to pay us $1,000 in cash. We recognize revenue. We recognize cost of goods sold. Now let's do something that's a little tricky. Now Dell gets $1,000 prepayment for a computer. Does it recognize any revenue? No, it doesn't recognize revenue because it hasn't delivered the computer to the customer. So the way that we're going to account for this is that Dell gets $1,000 of cash, and it's going to get some revenue in the future, which we call deferred revenue, but that's a liability right now. Now, sometime in the future, Dell delivers this computer. What do you think is going to happen then? So basically, this transaction shows that the deferred revenue on delivery of the computer becomes regular revenue. So deferred revenue is going to go away. $1,000 is going to decrease deferred revenue. That'll become regular revenue. And then the cost of goods sold side of the transaction is identical. Revenue recognition is very important because revenue recognition determines revenue. Once we recognize revenue, we recognize expenses by the matching principle. So revenue recognition determines revenue, and it determines expenses, and therefore it determines earnings. So the SEC, the U.S. Securities and Exchange Commission, keeps track of all the kind of corporate fraud that companies engage in. And when they look at it over a long period of time, so basically a 32-year or 33-year period of time, most fraud involves misstated revenue. So that's motivation for what we're going to do is you need to understand how companies are recognizing revenue to make sure that you have a sense that they're recognizing revenue correctly.